All right, can everybody see my screen okay?
Yes.
All right, cool. All right, well, based on the responses we got in the poll, it looks like pretty much mostly everybody was interested in macro market movements and strategy building, technical analysis as well. So I think we can kind of merge the three. Later on, we can definitely do very specific breakdowns of each as time goes on. So I started off with a basic. This is a weekly chart of the S&P 500, at least for the SPY ETF, dating back to about 1993. So actually, what we can do is we'll just pull up the actual S&P 500 index and look at that. So let me get rid of these trend lines here. Okay, so when we're talking about macro market movements, this is this is what we're referring to. So when in doubt, zoom out is kind of the is the saying. So we're talking about macro. We're talking about large over large periods of time. So you want to get a feel for how a market moves. A good way to do that is to pull it up on a chart and zoom out over several years. Um, this is the weekly chart, so you can. This spans from about this year all the way to 1982 ish. If you want to go further out, simply just change it from 1 week to 1 month, and that'll give you even a bigger snapshot. So let's make this logarithmic. There we go. So um, obviously the trend is upwards, right? No, I'm just kidding. So when we're looking at a chart like this, and I'm just talking to the people that don't know how this stuff works. I know a lot of you guys do understand it. So when you're looking at a monthly chart and you have the S&P 500 like this, if it's monthly, it just means that each of these candlesticks is 1 month of time. So that's a whole trading month, whole trading month, whole trading month, whole trading month. And these lines are the moving averages. So what you have to know when you're looking at your charts is your moving average settings. So on a monthly chart, you would actually have to go into your moving averages and change them to how many months rather than how many days. So let me go back to the weekly real quick. So weekly chart, we have this black line and we have this red line. So the red line is the 40-week moving average, which would actually translate to a 200-day moving average if you're looking at a daily chart. And then your black line is I'm sorry, the 40. The red line was a 40. I think I said 200. Um, red line is a 40-week moving average, which translates to a 200-day. The black line is a 200-week moving average, which is more of an indicator of an even longer period of time, um, hence the term 200 weeks. But basically, you're really only going to look at that 200-week moving average to see if you're in a really prolonged downtrend or if the market is crashing sort of hard, something like that. So, for example, if we look at that 200-week moving average, and this is the right about the peak before the dot-com crash. S&P 500 started its downward trend, touched that 200-week moving average twice before rejecting, going back up, and then closed down below it, came back above, and then started its move down. So this is over a period of several years. So these very long moving averages just give you a snapshot of a very long term trend. So if we if we look back, especially to the 70s, so it's about 1970s, starting from the 60s, you can see that as this black line starts to kind of flatten out, you'll notice the market is going up and then down and then coming back up, coming back down. So by the market moving sideways like this, it's going to cause this black line to curl over and then kind of go flat for a period of time, and then starts to sort of trend down. And then as the price action starts to go higher, that black line starts to move higher. So it just gives you a good snapshot to see where the market is historically. So if we go to today, you can actually see that the S&P 500 index tested that 200-week moving average. So that 200-week moving average is a very strong indicator to tell you that you could be either near a market bottom or you could be at I don't know if it would be a point of capitulation, but um, definitely it could be a determining factor whether it's the bottom and we're going to start to trend back upward, or a lot of times what will happen is it'll test this 200-week move average, move up, move back down, retest it, and then it'll either close below it or it'll reject off of it and then continue higher. So that gives you a pretty good indicator. You could see the same thing sort of happened in COVID. Let's zoom in here a little bit. So March of 2020, S&P 500, it moved below the 200-week, but ultimately ended up closing back above it. And then the next week here, obviously, it actually opened below and stayed below that 200-week moving average. So it was a strong indicator that the market was going to continue down. However, the very next week, it showed some bullish momentum, and it actually didn't continue downward. It actually started its next leg up. So 200-week moving average is just a nice indicator to tell you if you're either near a bottom or you're getting ready to enter a new period of market movement. You can see the same thing happened right about here. What's that, 2016, beginning of 2016. Over here, this is a much better indication of really sort of a hard recession where at first, you can see right here, it tests that 200-week, kind of bounces up, retests again, bounces up, but then rejects off of that 40-week, which is the 200-day, and then continues downward, closes below that 200-week, and then continues downward. So this right here, especially bouncing off of the 200-week, getting rejected off the 40-week, which is the 10-month or the 200-day. The S&P 500 really tends to respect the 200-day as well as the 200-week. So if you're bouncing off the 200-week, then you're getting rejected off the 200-day. That is putting you, let's see if we can sort of make some trend lines here. So it starts to sort of trade in a channel, right? But the problem is the channel is trending downward. So that it kind of gives you an idea of where the market might go, but you can never know for sure until these candlesticks close and then you have sort of a confirmation. So this is just a good way to determine long-term trends. So obviously, where are we at? So this is summer 2008, and obviously by September, October is when we started our really violent moves downward, and obviously the economy was spinning out of control. This is where Lehman Brothers had collapsed. I believe they went bankrupt. The housing market had collapsed. Things like that. So big big news making events in the economy and the world are going to play a role in causing the markets to dive like this, especially October 2008. I think all of those things were starting to happen at the same time. So People were defaulting on mortgages. I don't know if the Fed was doing anything at the time. I think inflation was still relatively normal. Um, the the um, the car manufacturers were getting bailed out, so a lot of things happening at the same time, driving the market down. So, and this is where we headed into a hard recession. I believe, let's see if I can remember this correctly, around December of 2009 is when they officially announced that we were in a recession. The problem is the recession really started somewhere around September, or not September, the summer of 2007. So right around here was where the recession started to show signs that we were, or at least heading into a recession. Okay, so that's the weekly chart. Obviously, the monthly chart is going to look similar. So this would be your macro, super long term trends. So this just kind of tells you where the market was, what the market was doing over the years. Obviously, it's overall the S&P 500 trends upward. I think everybody knows that. So this is a good way to sort of decide how you want to trade the market. So let's go to the daily chart. Does anybody have any questions before we keep going here? No? Okay. Let me make sure I still got everybody. All right, cool. Everything still looks like it's in place. Does anybody have anything to add before I keep going? Okay. So that is pertaining to the stock market. You could take these same moving averages and apply them to something else like commodities or gold or something like that. I'm mainly going to focus on the daily chart since a lot of the strategies that we're going to be building and have built are based on the daily chart since Composer does trade daily. So, but again, you can still use those same moving averages. All you have to do is manipulate the numbers, and I'll show you what I'm talking about. This more pertains to technical analysis. So if we take a monthly chart, right, and you still want to know what the 200-day moving average is on a monthly chart, here, let me hide that. So 200 days is roughly 10 months. All you're doing is basically taking 20 trading days in a month, or on average, it's about 21 trading days in a month, um, which is going to be 10 months. So 21 days times 10, you got 210. But the 200-day is what most people use. You could use a 210. It's not going to affect. It's not really going to do much of a difference. So if you're on a monthly chart and you want to see the 200-day moving average, you basically would type in 10 because that's about 10 months, and that will give you your 200-day moving average, which is that red line there. So it's 2022. That red line is the 200-day moving average. So if you're building a monthly trading strategy in Composer, you could use the monthly chart. You just have to make sure you're plugging in your moving averages a little bit differently. Another way you could do this is, I like this MA cross. So this is a moving average cross. So say you want to look at the 1 month moving average versus the 200 day. You'd simply put in, under the short length, you could put in 21, and then under the long, you could put in 210. And this is going to show you what the 1 month move average is versus the 200 day, or the 200 day. So basically the 1 month versus the 10 month. So You can kind of go back and see where they would have crossed over. Um, so here is the, did I do that right? No, I did not. I'm sorry. Let me back up. Not 21, 1. 1 month versus 210. So this would be, there we go. So that's 1 month. This is 200 days. That should put me on the right track. Okay. So it looks a little jumbled, but it's because this is a 1 month chart and each candlestick is a month. So basically, if you time that back to the 2008 crash, see the little blue cross right here. That is where the 1 month move average crossed below the uh, the 200-day moving average. So the 21-day move average crossed below the 210-day right there in November 2007. Which really would have saved you if you're using a strategy like this. You would have avoided all of this downside. Now, it crossed back above in June of 2009. The bottom of the market, I believe, was around March 2009, which is there. So you would have caught the trend back upward in June of 2009, found some instability right here, crossed back below, so on and so forth. So this is really to capture macro trends, not short trends like that. So you will get chopped up right here. You will experience some drawdowns right there because the market is indecisive in terms of the um, the 1 month versus the 10 month or the 21-day versus the 210-day. So what it's really designed for is to capture macro movements like this right here. So you would have had using the strategy, you would have entered back in here. It would have continued upward to right here, and then you would have closed your position. So that would have been a 49% move over 1,300 days. So this is really for long-term investors. It's not designed for swing traders and things like that. Swing traders tend to look at a shorter time period because they want to get in and out quickly and avoid the long-term choppiness or indecisiveness of the market. So that is the 1 month chart. Weekly chart, you could essentially do the same thing. I'm going to hop back over to the daily. All right, so the daily will tell you a lot more because it's a much shorter amount of time. So you could take that same moving average cross, and here you could plug in the 21-day and the 210-day. So this will give you a much more unique outlook. So again, if we went back, let's take COVID for example. 21-day is this yellow line. So this is about the 1 month move average versus the 10-month move average, the green line. Right about here, it crossed below, which was when the market really started to tank during COVID. Hit a bottom, started its trend back upward, and crossed right here in June of 2020. And then essentially you could have rode this trend up all the way to where we are now. So that that trend would have ended in February of this year. So you can capture macro trends, but it's just much easier to use the monthly chart if you're trying to capture big macro trends. But again, if you're using this, you can still avoid huge market crashes, and we're going to actually example this in Composer. So let me open this up real quick. And this is kind of where it's going to influence your strategy building. So if I take this and I look at it, it could tell me how I'm going to build a strategy. We know the S&P 500 respects that 200-day moving average, as you can see there. Typically in a bull market, well, it's hard. You know what? Let's go before the last 10 years because we've had a very strong bull market and it's unusual. So here it touches the 200-day, continues upward, almost touches it there again, continues its move upward. 2018 touches the 200-day once again, touches again in April, touches again in May, so on and so forth. 2018, you have sort of almost like a flash crash, and then it continues its trend upward again. COVID, flash crash, continues upward again. So you could take this overall movement of the 200-day and go to Composer and say, okay, I only want to trade the S&P 500 when it's above its 200-day move average. So easiest way you would do that is do an if condition, and you would simply plug in, okay. And there's actually several ways you can do it. This is the way I've found works best, but everybody's got their preference. So if the current price of SPY, which is the S&P 500 ETF, is greater than function moving average of price. Right here, you would plug in your 200-day moving average plug of SPY, and then you have your first sort of requirement. So if you're wanting to trade macro trends and you want to do the SPY when it's above its 200-day moving average, you would simply invest in SPY there. And then if you want to get out when it closes below the 200-day moving average, you could simply go to a short-term bond, something that has very low volatility. I like to use BSV just because it's a very short-term bond and doesn't have a whole lot of price action over a long period of time. So this is a good example of what that would look like. So let's zoom out. I think we can take BSV to about 2007, if I'm not mistaken, somewhere around May, and run it to see what that would look like. Okay, so the green line is your strategy. The pink is just the S&P 500. So if you look, the point of doing this, or the point of investing above the 200-day move average, again, is so you can avoid these massive crashes. So right around here, summer of 2007, like I said, the market started to get indecisive and sort of went flat a little bit. It was up and it was down, but it started its long-term trend downward. So as long as that current price is above the 200-day, it's going to stay invested. About right here is where that ended. So let's go look at the chart and see if that was the case. Okay. All right, so again, our green line is the, let me change it up so that we're only seeing one line. Okay, so that red line is a 200-day moving average. And you can see how the market started to get sort of trade sideways right about here. So still had a strong trend. March, May. Okay, so here's July. So here's where it started chopping up above and below the 200 days. So this tells you right here that something might be coming up soon, or there's some sort of instability in the market. So this started happening around July into September, and you can see that actually play out in your strategy here. So as it starts to chop above and below the 200-day, your strategy will start to do worse than buy and hold. It just is what it is. If the price is closing above the 200-day and then back below and then back above, your strategy is going to start to experience. It's sort of volatility decay, but not really. That more pertains to the leveraged ETFs, but it's still going to have the same effect on you because you're getting in and out consistently, and you're consistently wrong because it's closing above and below that moving average, whereas buy and hold is just buy and hold, so it's just riding the market. However, you start to win right about here at the beginning of 2008. Now you're in bonds, so you're essentially going flat while the market is still chopping sideways, and then is sort of starting a downward trend. So where you win is you avoid the recessionary crashes, dot-com bubbles, things like that. So you'll kind of go sideways because you're just in bonds as the market's crashing. Where you miss out is you're going to miss the bottom of the market, which is fine if you're just looking to ride macro trends anyway. And then you can see right here, the strategy picks back up, and that's probably right about where the SPY closed back above its 200-day moving average. So that's June 2009. I think we saw that earlier. So let's fast forward through the crash. Yeah, so here we are right here. June 2009, you can see the S&P 500 closed above its 200-day, retested, bounced off, retested again, bounced off, and then continued its next leg up. 2010, you get some choppiness again, and then it continues back up. So I don't know what was happening right here. We were still in a recession, obviously. The stock market tends to look forward or be forward looking. So when the stock market starts to rise again like this, it doesn't mean that the recession is over. It's just the recession, for the most part, has been priced in, and now the market is looking forward. Um, Here, I don't remember what was happening at the time. I know geopolitically, we were in Afghanistan and Iraq, but Afghanistan was pretty rough, I think, through 2011. I don't know if this was influencing it, but we were still in a recession, so that could have contributed to the choppiness of the market. If the Fed talks, it's going to make the market chop like that because people are starting to wonder, okay, should I take my money out? Should I park it in bonds? That didn't last very long, and we continued the next leg up. So 2011, same deal. Market chopped, closed below the 200-day, stayed below, came up, retested it for, I guess, about 3 days, and then went back below, retested it again, got rejected, came back, and then started its next leg up. So you're going to see that play out in your strategy if you're invested over the long term. You can see that play out here. These flat spots is where the strategy transitions to bonds. So, and then you can see it play out again, 2011, and then continues its next leg up. So again, where it benefits you the most is long-term trends. You can see, it pretty much stayed above its 200-day moving average through 2012, 2013, 2014, 2015. August of 2015, we saw a sharp decline in the market, transition to bonds. 2016, same deal. And then it continued its next leg up. So 2018, we had sort of a flash crash. 2018, the Fed, if I'm not mistaken, hiked interest rates, at least temporarily. There's 2016. Yeah, 2018 here. Yeah. So I know the Fed hiked rates temporarily, and then they pulled back, and then obviously you can see the market take off again to 2020. So bad news hits in, I believe, January. We had our first case of COVID, continued our uptrend, and then as COVID spread, people started uh, locking down, businesses were closing, then all of a sudden you have this extreme fear in the market. This is otherwise known as a black swan because you can't predict something like COVID. So you're going to get these sharp, massive declines, very violent drops downward, and then typically it's followed by a V-shaped recovery like that. And you can actually see that bear out um, in 1987 as well. So let me try to jump over to 1987. Okay, so right here, same deal. I don't even know what was going on at the time because I wasn't born until 1989. So, but anyway, Black Monday, I believe, was here. October 19th, you can see at the top of the screen it says minus 20.46. So S&P 500 saw a 20% decline in one day. Um, that's extremely rare, but again, that would be a black swan. So, but looking at the macro trend, it is nice knowing that the S&P 500 respects that 200-day moving average. You can see it there, bounced off, continue up, bounced off here, continue upward, and then dropped. Here it is again, respecting the 200-day, respecting the 200-day. Got some choppiness here. This is 1990. So that is a broad look at the macro movement of the S&P 500 and how you can plug in your moving averages to see what the trends are on a stock or an ETF or whatever. So now going back into Composer, let's bring this all the way back out. So by doing that over a long period of time, you're going to avoid those crashes, but also you're going to stay above buy and hold for a prolonged period of time because buy and hold is going to take a long time to uh, make it out from being underwater. So if you were simply just following the 200-day moving average strategy, you actually would have been beating the buy and hold S&P 500 till about 2016. It took to catch up. So, and then even there, you stay pretty closely correlated um, all the way until about this year. So if we go to the year to date, actually we could just do like a 1 year. So this year is sort of unique because we're in a Federal Reserve quantitative tightening period, which means that the Fed is reducing the money supply by selling off their balance sheets. Um, and that's why bonds are declining along with stocks. They're not declining at as rapid of a rate, but they're still declining nonetheless. Let me go, actually, let me do this real quick. Should have showed the rate of return and the drawdowns and stuff. All right, so if you take that 200-day moving average strategy, it still performs closely correlated to the S&P 500. You're not going to beat buy and hold, and especially dollar cost averaging. You're not going to beat dollar cost averaging, although you should be dollar cost averaging in your own strategy as well. So where you really win is the drawdowns. So max drawdown of buy and hold 55% versus a max drawdown of just 21% for the 200-day moving average strategy. So, and that is a very bare bones one line strategy. You can easily take that and start plugging in more steps, and you're going to start to outperform the S&P 500 pretty quickly. So let's see here. Let me go. Let me go all the way back up here. What's the other what people wanted to see? Okay, so strategy building versus macro market movements and technical analysis. So yeah, I'm pretty much doing all three of these in the same video, which is fine. Like I said, we can definitely have more specific classes later in the future. This is kind of our maiden voyage. I wanted to jump on and kind of hold one of these so people can get a rough idea. So this is more for the people that don't quite understand either what we're doing or how we're doing it or things like that. So um, this will give you a very good idea of how you can get in and get out as far as over a longer period of time. So what you can also do is if you want to improve on your strategy, you can look at a shorter period of time and say, okay, now that the S&P 500 is below the 200-day moving average, how can we capitalize on it? How can we continue to make money as the market is declining, and we don't have to just be buying long positions in the market? We can be buying short positions too. So now that we're below the 200-day, you can see that the S&P still has, and this goes for everything else, the NASDAQ, commodities, take your pick. It has drops, and then it has ups, and then it has drops again. So how do you capture some of these moves, whether it's down or up? So um, what's interesting is once we're in this declining period under the 200-day, other sectors of the market tend to suffer more than the S&P 500 or the Dow Jones Industrial Average. So what you could do, and what I like to do, is say, okay, well now that the S&P 500, which is the Standard and Poor's 500 largest companies on the stock market, I think it's the 500 by market cap. I forget, but it's basically an indication of the overall stock market. So um, tech tends to suffer first. So you could go look at the NASDAQ, which would be QQQ. QQQ is an ETF that tracks the 100 biggest companies traded on the NASDAQ. So you could then look at the NASDAQ and say, okay, if the NASDAQ is going to suffer more than the S&P 500, that means I could capitalize on their moves underneath the 200-day moving average. So what you could do is take your moving averages and actually plug in a shorter span of time, like a 21-day or a 20-day. I like to use the 20, but I know a lot of people use the 21 because there's an average of 21 days in a trading period. So what you'll notice is once we've closed below the 200-day, which is the black line, now you have this blue line, which is the one. This is basically a 1 month moving average of the price action. Each of these candlesticks being 1 day. The blue line will give you the previous 20 days of average movement. So you can see that the price action tends to respect that 20-day. So if it closes above and continues above, you know you're in a probably most likely a temporary rally since you're still below the 200-day moving average. So notice the NASDAQ closes above its 20-day, continues upward, makes contact with its 200-day, gets rejected, retests it, and then continues downward. So this tells you when it's testing the 200-day and getting rejected, this tells you that the bear market is most likely going to continue. So then the price continues downward. Let me zoom in a little bit. I'm sorry. Okay. So now here, you can see the tail of the candle, meaning the market opened up here at the top of the candle, moved down, touched the 20-day, got rejected, and then closed up here. So that shows sort of, that looks more like I guess that would be considered they call it a hammer, but maybe not quite. But anyway, it touched its 20-day move average, bounced off of it, and then closed above it. So this potentially could be another pivot point. So the next day, market opens a little bit below the 20-day and then actually closes above it. So um, still don't know. The market could go either way, right? Because it's just too close to call. Now the next day, market opens, drops here, closes here, and then the day after that closes below. So closes below. This sort of tells me, okay, this might be the next leg down. Now notice the market goes sideways for what's that? 1, 2, 3, 4, 5, 6, 7, about 8 days before it starts its next leg down. So right here, it could be one of those pivot points where your strategy could suffer. And this is something that we are working on right now to potentially try to avoid something like this. But it is what it is. You're going to have this in any market. So starts its next leg down, reaches a bottom. Let me bring up the RSI here. So if you'll notice, if you're looking at the 10-day RSI on the NASDAQ, when the RSI reaches the bottom, typically if a stock or something drops below 30 on the RSI, it's a good indicator that the stock or the ETF or fill in the blank is oversold. It doesn't mean that it's going to bounce. It just means that there's a good chance it could bounce. Um, so that tends to happen once it reaches the bottom. So if you notice, it happened here, April 26th. It sort of went flat the next day. It only lost 0.12%. And then notice the next day, the NASDAQ jumped up 3.5%. So if you were putting your money, if you were betting that the market would rebound, you would have got rewarded nicely. But it is a risk. You are taking a risk for sure. So did the same thing right here in May. Went flat for one more day, and then got a nice rebound, 3.7%. So if you were in TQQQ, you would have made roughly just about over 10%, which would have been nice, and then you would have got right back out since the RSI was above its 30 range. So you would have caught a nice bounce there. You would have done over a 10% bounce. Same thing there. You would have done over a 10% bounce and then continued to ride the wave down. So let's just take this. Oops, why is it doing that? And kind of look at this. So the range is roughly around, it's just a rough estimate, but it's about a 20% decline over about 50 days. So what you could do is say, okay, let me see if I can ride the wave down by plugging in another if statement. So now that we're below the 200-day move average, you could take that and say, okay, if the current price of QQQ, which is the NASDAQ, is below or less than its 20-day move average, oops, of QQQ. Now you have another sort of a check. If this happens, do this. So if the current price of QQQ is less than its 20-day move average, let's just say, okay, we just go short, just straight up short the market. So PSQ, which is a 1x inverse of QQQ. And if that's not happening, just stay in bonds. Then you could run it through and see if that's a good idea. Okay, so lowers your return and actually increases your drawdowns. And people might ask, okay, well, why is that happening? I thought we could short the market when it's declining. Well, you can, but you need to be careful because there's a lot of volatility when markets are in decline. So where it would have helped you temporarily is here at the beginning of the crash in '08. You could have caught these nice waves up, but see how it's dropping, going up, dropping again, going up, dropping again. So all these sharp price actions, that's all volatility happening below the 200-day moving average. So then you could look at that and say, well, okay, I want to avoid the volatility, but I still want to ride the trend. How can I do that? Well, if you back up and you look, like I said before, if you look at these oversold periods on the RSI, and this is just a 10-day RSI, you could use a 14-day, you could use, well, the general rule is a 14-day, but that's sort of the default setting. But I've found that you can actually capture a lot more bounces if you're using the 10-day, and I mean 10 days is just it's a 2 week moving average on the market. So I tend to like to look at the 10-day. There's more opportunities there. It's also riskier, but that's just the way I prefer it. But feel free to use a 14-day. You can still catch bounces on a 14-day. So actually, what you can do is go back and look at your strategy and say, okay, before I start shorting the market, let me try to catch those oversold bounces first. So the way you would do that is go back in and see if you can catch these oversold bounces on RSI. So the way you would do that is relative strength index, 10-day window of QQQ. And you could do it with SPY too. It doesn't really matter. You could do it with Dow Jones. You could do it with whatever you want. Less than 30. And if you look, the reason why we say 30 is because that's generally the range of how RSI is calculated. If you look over here on the right hand side of the screen, the boundary line is set to 30 and the upward boundary is set to 70. So if a stock or an ETF or whatever is above 70, it's considered overbought, meaning the market's really frothy. It's the momentum. Um, Generally, people are going to start taking profits around these parts, or the volatility is going to start increasing because price action can't just move up forever. So at some point, it's going to experience a sort of correction or a reversion back to the mean. The mean being this range between 30 and 70. So when we talk about mean reversions, that's what we're talking about. Reverting from above 70 back into the mean. Same thing below 30 back into the mean. Dropping below 30 back to the mean. Below 30 again back to the mean. Bouncing off the 30, so on and so forth. So you could take your next rule and say if the 10-day RSI on QQQ is less than 30, I'm going to buy QQQ because I'm looking for a bounce or a mean reversion. So, and if that's not happening, we can just go back to bonds and wait for more opportunities. So if we do that, let's run it back, see what we get. Okay, so now you're outpacing the S&P 500 by quite a lot, and you're actually reducing your max drawdown as well. So if you look at the back test, now your strategy is vastly outperforming the market, and all you simply did was buy dips in a bear market and then ride the bull market waves up. So let's see what that kind of looks like. So this is before you've even decided to short the market or anything, which is kind of nice. So if you look at I always like to go back to the 2008 crash because there's a very violent, very prolonged crash, and a lot of people lost their ass. So you can see here we're pretty much flat. We're in bonds, 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 and then right about here looks like we were either above the 200-day or we were catching 10-day RSI bounces. Now, like I said, it is riskier, but the payoff tends to be higher. So if you look, the riskiest part about buying dips is at the beginning of a crash because you don't know how long the market is going to decline for. It could decline for 4, 5, 6, 7, 8 days. You really don't know. So that's the risk of going 100% all in on some of these dips. However, once the crash has started, so uh, what we were doing here was attempting to buy the dip, but we kept writing it down, and then boom, you got a rebound. So you caught that rebound, and then the strategy continued to go up while the S&P 500 continued its downward decline. So right there, there's another dip, and you can see because the strategy rebounded once again. And then let's see, there's another bounce here, boom, so you jumped up. So basically, about right here, they were kind of equal, right? So as we entered the crash, started buying these dips, and then you can see just by buying the dips, it quickly starts to increase your I don't know what you call it, your rate of return, basically. So your rate of return starts to increase while the rest of the market is continuing to decline. So we're in bonds here. Might have caught an oversold bounce. It looks like we caught an oversold bounce right there. Continue downward, and then looks like we caught another bounce there. So by November of 2008, the strategy is actually up 34%, while the S&P 500 is negative 37. So that's pretty good. And all we're doing is buying the dips. We're not going long. We're not going short. We're just trying to stay flat and catch these bounces. So there's another bounce there, another bounce there. So now we're up 48%. S&P 500 is negative 42. So you can kind of let that play out. And then by the biggest thing to me is by buying the dips, your buy and hold is most likely never going to catch up after a market crash. It's just not going to. Um, and you can see that play out here. So it never caught up. Now, here's why I say it's risky. Because in a shorter window of time, it's going to look kind of dangerous. This is a good example right here. So we're in the S&P. It's above its 500 day, or I'm sorry, it's 200 day, and then we have this sharp decline in August of 2015. So the reason why we stayed in is because we were trying to buy the dip, but the market wasn't rebounding; it just continued to fall. So we were falling right along with it. Um, here's where it'll bite you if you're not in investing for the long term. You'll catch a rebound and then go back to bonds. Um, Catch a rebound right there, go back to bonds. The problem is you're not catching the bottom of the market. You're waiting for the price to catch up with its 200-day moving average. So buy and hold is going to outpace you in a shorter window of time. You can see here, tried to catch a rebound, didn't happen. Or actually, no, I'm sorry. This is probably when the S&P is back above its 200-day. So closed back above its 200-day and then started to decline again, and then we got out. You can see there we got out, but then as we got out, the S&P started to recover again, and then it started to decline again. So this choppy market movement can trip you up, but ultimately, in the end, as you can see right here, I think this is the beginning of 2016. So in the beginning of 2016, we were catching these rebounds, and we kept catching them. So let's say we caught 1, 2, 3, 4. So we caught about 4 rebounds, and then quickly caught back up to the buy and hold S&P, and then didn't really get an opportunity again until it closed it back above its 200-day. So that's an example of the risk taking that you will encounter if you're going to try to buy those dips on the RSI over oversold moves. But if you plan on staying with it long term, it's going to benefit you, but you are taking a risk. So you have to be willing to take the risk of buying those dips. So there it is again. This is 2018, October of 2018. So again, S&P fell below its 200-day, and then we started buying dips. So caught a nice rebound there, caught another one there, got screwed there, caught one there, got screwed again, got screwed again, and then bounced up. But the important thing is you were doing better than you weren't falling as far as the S&P was falling. So, um, but notice buy and hold will start to catch up with you again. So if you're looking at smaller time windows, it's going to look like you're underperforming the market. But you have to be you have to have a long term mindset to understand that you're. It might look like buy and hold is outperforming you in the short term, but if we back up and we stick with the strategy, this shows you that it vastly outperforms buy and hold on a long term level. So last one we'll look at is COVID actually, because COVID is a interesting sort of case of a very violent move downward. However, you for the most part avoided it. So you're trading with the trend. S&P closes below its 200-day somewhere around here in March. So then you were buying dips at that point. So bought a dip, bought a dip, bought a yeah. Actually, no. I'm trying to see where that bounce is coming from. That might just be the bond movement. So anyway, in February, before the crash started, you were neck and neck with the S&P, and then if you actually look here, you see at the bottom, S&P was negative 28, and you were actually positive 4. So with flash crashes, it could help. Again, you're still taking a risk regardless, so just be aware of that. Right here, S&P closed back above its 200-day moving average, and then you just traded with the trend after that. So fast forward to today. Yeah, see, even through COVID, you would have outdone the market, and then just went to bonds after. You are dip buying here, but it's not doing much. And the reason why it's not doing much is because bonds are declining. So even though you're buying dips, yeah, you're catching these rebounds like there, but overall the the bonds are still declining. They're not declining by much, but they are declining. They're just not going as fast as the rest of the market. So you'd still be up 4% as opposed to the S&P 500 is still underwater. So that's the nice part. So that is simply just trading with the trend and buying dips. Then you could go back into what we were talking about before with that 20-day move average. If the price is below the 20-day, see if you can ride the wave down as well. So we'll go back over here. And plug that in. So the current price, QQQ, is below or less than its 20-day. You can go short. And then just go back to bonds if it is not. Okay, so 14.3 and 18. Now your drawdowns are probably going to increase because of the volatility. So you got a higher annual return, but you also have a higher drawdown now. And that's, again, that's due to the volatility happening below the 200-day moving average. So you're gonna experience more choppiness when trying to short the market. However, it's still going to help you in the long term. You still have to have that long term mindset to really outperform. So obviously, you can see here in COVID, you were shorting the market, and then you kind of fell back down with it as the market started to recover. This year, where it's really going to help you is in long-term down markets like 2022. Obviously, now you can see, actually, let's just go to year to date and look at that. So if you look at 2022, see how the SPY starts a downward move and your strategy starts an upward move. That's because you're shorting below that 20-day move average. And then as the market starts to come back up, you're going to hit a temporary decline in your strategy. Same thing, market goes down, yours goes up. And at the same time, you're still buying the dips before shorting the market too. So from August to right around October 14th, we had a prolonged down period. So this was actually very beneficial for us shorting the market. And this is just straight shorting the market. It doesn't take into account getting out at certain times, getting back in, so on and so forth. So this could help you, but you're going to experience more volatility and probably higher drawdowns because of the volatility below the 200-day. Anybody have anything to add before I keep going here?
Nope.
Okay. Let me open the chat real quick, actually. Guess I could just click here. All right. Let's see. How many people we have in here? 5. Okay. All right. So the next thing you could, when looking at something like this, is you could say, okay, the returns, that's cool, but how do I expose myself to less drawdowns or less risk? Okay, well, if you know that there's a lot of volatility happening below these 20-day move averages, um, how can you address it? Well, when I was when I first started building my TQQQ for the long-term strategy, that's that's something I was trying to address. Yes, I want to short the market at in these down periods, but I don't want to just stay short because there, as you can see, it rebounds and then continues downward, rebounds, continues downward. So how can I essentially know when to get out of shorting and when to get in? So I started looking at a lot of different ways that I could address that, and the most successful way I came up with was actually looking at the RSI between stocks and bonds. So if we go here, this is a RSI compare tool, and the way you can find this, Garen covers it in one of his videos, but in case you haven't seen his videos, simply, hopefully everybody gets very familiar with TradingView. This is TradingView. This is a free site you can use to track stock charts, whether it's commodities, ETFs, indexes, it doesn't matter, gold, take your pick. Up here, you can go to indicators and search for something called RSI Compare, and it looks like this right here. I've made it one of my favorites so that I can find it pretty quickly, but it's made by this user here, Captain and Oscar. So um, this is RSI Compare, and what this tool does basically is compares the RSI of two securities, assets, whatever you want to call them. So 10-day, I'm using the 10-day RSI, and what I'm doing is comparing short-term bonds to the NASDAQ ETF, which is QQQ. Or I'm sorry, the inverse ETF of the NASDAQ, which is PSQ. So this is a 1x inverse. It's not leveraged. It's not none of that. So let me go here and unplug that. Okay. So as you can see, now this year is a little different because bonds are declining at the same time that stocks are declining. However, it's still beneficial to use. So BSV is a short-term bond, and PSQ is a 1x inverse of the NASDAQ. So essentially what it does is kind of can tell you when to stop shorting the market before the market actually turns around. So it's just measuring the strength of short-term bonds versus the movement of the inverse ETF. So take this period of time here. This is all happening below the 20-day move average. So as you get closer, you can see these start to converge on each other, and then bonds actually start to outpace or have stronger movement than the inverse ETF that you're shorting the market with. So this actually would have traded out of, let me see, 62.28 and 62.84. So here on May 25th, the strategy would have transitioned to short-term bonds and got out of shorting. And what that would have done is you would have avoided this 2.7% increase in QQQ, whereas you would have experienced a negative 2.77% decrease because you were shorting the market. So what that looks like when you're building strategies, you can say, okay, I don't want to just go pure short. Let me measure bond strength versus the inverse strength. So let me back up. Okay. So what you can do is go here to a filter. So it says sort and filter assets by their attributes and other indicators. So essentially what you're doing is you are sorting between the RSI of bonds and inverse ETFs. So if you go down here, simply just plug in relative strength index. Still going to use the 10-day RSI. And then if you go here, function, top or bottom. Top just means which one do you want to invest in, the stronger one or the weaker one. So if you want to invest in the stronger one, the one that has a stronger RSI, you're going to select top, and that's what I'm looking to do. I'm looking to transition to the one, whichever one is stronger, and then one just means you're just investing in one asset or one security, whatever you want to call it. So then you're going to plug in which ones you want to compare to each other. So I want to compare short-term bonds to PSQ, which is the 1x inverse of the NASDAQ. So you'll plug those two in, and basically it's going to sort whichever one has a stronger 10-day RSI. That's the one it's going to invest in. If that is not occurring, this is occurring below the 20-day move average. So if it's above the 20-day move average, you're just going to go to bonds. So plug that in and see what it does. Okay, so now it has still increased your returns, and it's actually decreased your max drawdown, which is what we're looking for. Because we just want to know when it's good to be in and when it's good to be out. So just by doing that, just by filtering between short-term bonds and inverse ETFs, that can kind of help us out. So now, if you go back to the crash in 08, now you're starting to see how your strategy can start to travel upwards as the rest of the market is traveling downwards, because not only are you buying dips, but now you're shorting the market and then getting out when bonds start to get stronger than inverse funds. Now, it's not always going to be right, and you can kind of see that here. It's declining with the market, but it's temporary, and then it kind of starts to turn around. And then so, let's see, about February 2009, you actually would have shorted the market precisely right to the bottom. So the bottom is right around here, March 2009, and you reached kind of a top Looks like you had a couple of days of declines, but then you reverted back to your bonds and then got back in the S&P when it closed above its 200 day. So if you go to this year, you can kind of see that play out. So you're riding the inverse as the market's declining, and then you're still going to experience some chop. It is what it is, but you do need to have that long-term mindset. So again, here in April, you would have rode that wave up, transition to bonds, and you can see the reason why it's transitioning to bonds is because QQQ is above its 20-day moving average. So you're just going flat while the market temporarily rallied and then continued its next leg down. So about June, continued its next leg down here. You rode that up, rode it back down, and then got a little bit of a bump and then went back to bonds. And you can see here, this is a nice stretch where you might be able to take advantage of that QQQ being above its 20-day move average, and we'll address that in a second. So next decline, you would have caught that price movement upwards and then went back to bonds. And then here we are in November. So let's see what that looks like. So what you could do, now this is just short-term bonds. You could plug in essentially anything you want. You could look at 1 to 3 year treasuries. You could look at, I believe it's 5 to 7. You could look at 10-year treasuries. Take your pick. So let's just play around with this real quick just to see. It helps in any scenario. Comparing bonds to inverse funds helps you regardless. So it's really up to you of which bonds you want to use, whether it's short term or long term. So 65 return. This is the year to date. So 65% return with 13% max drawdown. That's using short term bonds. You could use 1 to 3 year treasuries. That yields a 66% return, about the same drawdown. You could look at, oops, what did I do here? IEI, which is a 3 to 7 year treasury. Play with that. 53, 14. So lower return, lower or a higher drawdown. So that's a 3 to 7 year. IEF is going to be your 7 to 10 year. 59, 14. So these midterm treasuries looks like they perform relatively the same. IEF, oops, what did I do? I already have that plugged in, don't I? Okay, yeah. So IEF is your 7 to 10 year. You could plug in TLT, which is a long-term treasury. That's your 20 plus year. That yields 50% return, 13% max drawdown. So lower return, but you keep a lower drawdown as well. So, but you could plug in more than one treasury. You don't have to just compare two assets. You could compare 3 or 4 different bonds with an inverse ETF or whatever. You can.
Hi, Derek. So as you're doing this, one of the things I was wondering is if we could try to basically hack together an improvement that basically says if we're in a period where long-term bonds are making more than short-term bonds, then you're going to stick in the long-term bonds in there. If you're in the reverse, short-term bonds are doing better than long-term bonds, then you're going to stick in a short-term bond there, and so it actually will adjust for you and choose the best one for the conditions that we're in versus just being able to pick one.
Yeah, that's a great point. So are you saying you want to filter which bonds are stronger first and then decide how to
So we would do something like, for instance, if this might not be exactly right, but in the general idea, if the 60-day returns of TLT are bigger than the 60-day returns of the very short-term bonds like BIL, then you will plug in TLT over there as you have right now, and then the ALF will be Otherwise, we will use VIL and the shorting of the market. So you'd have two choices depending upon, if long-term bonds are doing well or if long-term bonds are doing poorly.
Yeah, and you could definitely do that, and this is how we would plug that in. So you would delete your filter, and then you would add another step first. So you could go. I'm going to go with what OK High is saying. So um, cumulative returns. So you could do a 60-day cumulative return, and you could
Yeah,
say
I'm not necessarily sure that 60 is the right number, but I could have sworn that I've seen people use like a 60-day in some
yeah,
other code somewhere, so it sounds about like it should probably be decent. It might not be the best, but
yeah, for
if it's
sure.
too short, then it definitely won't be very good.
Which is fine. With long-term bonds, you could easily do a longer-term trend too, like 200 days, 400 days, whatever. And but let's just try 60 first and see how it plays out. So what you would do is you would go if 60-day cumulative return of, let's just take the longest and the shortest. So TLT is greater than the 60-day cumulative return of, I could do BSV, but I think a lot of people in here like using shy, so I'll go with shy.
Yeah, I was actually thinking to use VIL because then you can essentially use TLT for one, and then you could use VIL for the other one, so that you're basically, in normal market conditions, you'd probably choose TLT all the time, and then when you get to like now where bonds are doing bad, you're going to choose the bonds that are doing the least bad.
Yeah, yeah, makes sense. It makes sense. Okay, so this is what that would look like, what he's describing. So basically, if you're wanting to decipher between whether long-term bonds are doing better or short-term bonds are doing better, you would plug this step in first and then do your filter where you can short. So if TLT, if the 60-day cumulative return of TLT is higher than bill, you would use your filter with TLT and PSQ. If bill is stronger, or if bill has a higher 60-day return than TLT, you could filter with bill. So then you would go in here, insert bill, and then that's what it would look like. So let's try this out and see how it plays out. So 9.5, 13. So you kept the same drawdown.
Maybe the movement of bill isn't enough to actually work in that function. Maybe it does have to be the like the shy or the something one to 3 year bond instead of 1 to 3
yeah,
months.
it may need to be a yeah, it may need to be BSV or shy, or the 60-day might not be enough to measure. Well,
Okay.
let's test it out. So BSV, and then we will plug BSV here and see how this plays out. So let me make sure everything's right. 60-day greater than C. Okay, BSV. Okay, so let's try that. So yeah, 65. So pretty good. I think that's about the highest you're going to get as far as comparing bonds with long term or short term versus long term. And then let's actually see if that played out here. So you can see November 2nd, 3rd, and 4th. So I don't know if people know, but this it went into PSQ on November 2nd, but really what this means is it went into PSQ at the end of the day on November 2nd. It doesn't mean that it was in it was in PSQ the entire day. Um, I don't know if a lot of people know that or not, but I did figure that out by comparing these holdings versus looking at the charts in TradingView. But anyway, that's just a quick little side note. So let's go to the beginning of the year. So we were still above 200 day. QQQ. Oh wait, where did we go to QQQ at? Oh yeah, buying the dip stuff. Okay. Um, so buying the dips on QQQ, went back to SPY. Okay, here's where we started shorting the market. So 200-day, buy the dip, back to shorting. Okay, so right here, if it was in BSV, that's telling us that the 60-day cumulative return, at least in March, on BSV was actually higher than the 60-day cumulative return on TLT. And it makes sense if you think about long-term treasuries this year have been doing much worse than short-term treasuries or short-term bonds. So if you look at TLT, let's just go year to date. Okay, so if you look at TLT, it's in a pretty dramatic downward trend, and then you can actually even compare it to BSV. So you can see sometimes it's funny. Sometimes BSV falls sharper than TLT does, and then other times TLT is falling sharper than BSV. Or maybe I'm just getting tricked because I'm using bars and lines. So, um, but yeah, you can see they're both declining, but they're not exactly correlated either. So, um, this is this would be a good thing to measure in your strategy. So you could absolutely put that in there, and I think it will help over a long-term trend. So you can see here it was shorting, went to BSV, went to BSV. So it hasn't gone into TLT at all this year, and you can tell because TLT is not even listed up here, which tells me the 60-day cumulative returns of TLT have been probably dramatically lower than BSV. So what you could do is you could try this too. You could say, um, if you want to measure a more long-term trend, you could do maybe not cumulative return, but you could do moving average of return and say uh, let's just do 252. That would be 1 year. Um, that would be 1 year of worth of trading days on each one, and you could do moving average of return. You could look at it that way too, and if TLT is better, then it'll use TLT. If not, it'll use BSV. So 58 and 13. So let's see if it was using TLT. Yep. So here it actually did use TLT, but I'm wondering, yeah. So it looks like it was closer to the beginning of the year. It would have used TLT. So TLT was stronger than BSV at first, or at least it had a higher moving average of returns over a 1 year period before, yep. And then in March, it looks like BSV was probably had a higher moving average of returns. So that's how you could use that. And you know what? Let's look at this. Let's go to 2008 to let's just say 2010. Because TLT probably would have been much stronger. What the hell? Oh, I can't. 252 day moving average of BSV. Okay, let's use shy. Shy should be relatively close to BSV. There we go. Okay, so 65 and 18. So let's go look down here and see. Yeah, see BSV and TLT were both used at one point. What the hell? Come on, man. Oh, it's in December. That's right. Okay. All right. So TLT looks like TLT had a stronger 252-day moving average in. Oh, you know what? Yeah, January 2008. What's going on here? Oh, duh. My bad, guys. Okay, here we go. So TLT was outperforming short-term bonds. So long-term bonds were outperforming short-term bonds in 2008, which makes sense because we weren't in any sort of like Fed quantitative tightening cycle or interest rate hike cycle or anything like that. So long-term treasuries. Well, let's just fast forward to the crash and see. Long-term treasuries should have been the go-to in the crash of '08 rather than short-term. Here we go. So here's where we're starting to see some chop in the market. So yeah, so TLT and then it goes over to BSV and then shoots back over to TLT. I think that might be due to the fact that, yeah, so BSVs are sort of cash position here, and then our shorting is between TLT and SHI. Okay, so let me look at that. All right, so TLT was stronger than SHI. That's what we're comparing. So TLT was doing better than SHI in while the market was crashing, so we would have stayed in TLT if it was if we weren't shorting the market. Here's BSV, which means we're probably above the 20-day. Back to shorting, back over to TLT, buying the dip, back over to TLT. So yeah, long-term treasuries tend to be the better way to go when you're not in some sort of inflationary environment or a quantitative tightening cycle or something like that, because long-term treasuries are going to be declining, as you can see with this year. Um, well, I guess look here, but yeah, so that is a good way to do that, and you can definitely plug that in if you wanted to. So um, you can see how when building a long-term investing strategy, it starts with a very simple basic rule, which is that 200-day move average of SPY, and then you can see how we kind of slowly progressed into kind of plugging in these more complex steps. They're really not that complex um, when you understand what you're doing. But for somebody who's just coming into this, they might look at this and go, "What the fuck is going on here?" So, um, and then now we end up at BSV. So, what you could do if you're if you still want to get more aggressive, or if you just want to keep making money pretty much at all times, is you could look at these flat spots and say, okay, how do I take advantage of the flat spots and try to ride the trend essentially, instead of just staying in cash, or you could just stay in cash. It's really up to you. So you could take that. The flat spots, we know the Nasdaq is above its 20-day move average. That's what these flat spots are telling us. So you could then go to BSV and erase it and say, okay, if the NASDAQ is above its 20-day, I'll just invest in the QQQ and ride those trends up. So let's see, 58 and 13. Let's see what it does now. So now this will take you to 79 and 13. So um, didn't change your drawdown at all. It just increased your annual return, and that's obvious because now you're taking advantage. Now you don't have those flat spots anymore. You have these slowly rising. Um, your strategy is slowly rising because it's riding that 20-day move average, and then it's shorting below the 20-day. Um, so it'll be interesting to see. Since October 14th, our strategy has kind of started to decline, And I know a lot of people are getting frustrated with that because a lot of people are in beta baller and that they're wondering what the hell's going on? Why am I losing money? The reality is you probably just came in at the wrong time, as the market is maybe starting to turn over, but maybe not. We don't really know yet. So if we just get rid of all the noise and just look at this, the chart, what the chart is telling us, well, here you go. Notice the blue line is 20-day move average, right? See how it's kind of just going straight across, starting to decline a little bit, but right here it's kind of flattening out again. So so it was below the 20-day here, below, crossed above. So that means we would have went long, and then we would have captured that. We would have captured that. Well, the next day there's a negative 2% decline. Then there's a negative 1.8% decline, but it didn't cross below the 20-day, so we're still long. And then the next day you would have caught that nice 3% bounce, and then the next day you would have had a negative 1% decline. So this is chop. This is choppiness right here. When you're having these dramatic of swings in a very small amount of time, this is sideways market movement. So, but this can be explained too, though. So, um, if you look at the RSI, well, we were oversold back here in the beginning of October. Then you had a nice bounce there. Then you had a sharp decline again. So, um, what have we had right here? Well, earnings season started right around here. So you have tech companies reporting earnings. You have companies that are on the Dow Jones Industrial Average, or excuse me, on the Dow Jones, um, and I believe even some of the companies on the S&P 500 too. So they're all reporting earnings, and a lot of them are missing earnings. They're underwhelming earnings, things like that. We're not in a recession yet, um, but the signs point to we're headed there. So the problem is when the Fed is in a tightening cycle and they're raising interest rates and stuff, and then you have companies reporting good earnings or um, uh, they're missing earnings, but they're not really experiencing any sort of um, really bad losses or anything yet. The problem is the market is still going to react negatively to that. So let's say, for example, who was it? Oh, Apple. So Apple, their earnings were great. However, they missed on, I believe it was iPhone sales or something to do with the iPhone. So even just that one piece of negative news made their um, stock tank. But then what happened the next day? So where did they had one day it was like really, really bad. I can't remember when it was. Was it there? Was it after? I think it was here, October 27th. So they declined, even though they didn't miss on earnings. They just had bad iPhone sales or something like that. But then the next day, they rallied 7.5%. So you just never really know where the market's going to take you. But then after a 7.5% rally, most people would think, okay, that's great. This is the next run up. But then you have a doji candle here. So a doji candle means indecision. Um, the bulls and the bears are basically fighting, and the price action didn't go anywhere. It went up, came back down, it went down, came back up, and it just closed in the middle. So that's indecision on a price. So the next day it could either drop or it could shoot up. You don't really know. Yeah, in this case, it dropped, and then it dropped again, and then it dropped again. So basically, these three, I guess maybe 4 days, that's kind of a flat day. These 3 days were almost like a rug pull for this 7.5% up day. Um, it is what it is. Nobody can predict what's going to happen. So, for a lot of the people coming in to these strategies right now, let's say you just you just came in on, I don't know, pick a day, October 25th, and you're just noticing, oh my gosh, I'm just getting these declines, these declines. You're in a very short window of time. Um, just because the strategy has been declining since the 14th, it doesn't necessarily mean that the strategy doesn't work. And that's what I was saying by you need to have a long term outlook. Um, because let me pull this in and get rid of all of the euphoria. So take this for example. So this strategy is pretty much doing the opposite of what the S&P is doing. However, 2 days it went with the S&P, 2 days it went down with the S&P, one, and then they both went up, both went down again. But then here, I can't remember. Anyway, the S&P went down while the strategy went up, but then the next day the S&P went up while the strategy went down. So you're going to have periods of time where your strategy gets caught in a choppy um, movement. It is what it is. This tends to happen around pivot points in the market, and you can see. Let's go back to. Let's just go to SPY. So you can see it's up, it's down, it's back up. So this when your moving average line goes flat like this, that just simply means that you could be either in a at a pivot point where the market will start to go upward or it'll start to go downward. But there could be a period of time where it could be a week, 2 weeks, where this moving average might not do much. The price might fluctuate up and down. Um, a good indicator of sideways movement is if the market is moving sideways, your RSI is typically going to start to decline. Um, even if the price action is moving sideways, the RSI will go down. So let's take here. So this is pretty sideways price movement here. However, if you look at the RSI for the same time period, is starting to decline. Goes up a little bit and then drops back down. So here's another sideways period here. So RSI came up, dip, dip, up, dip back down, and then started to decline. So um, that's a good, and if you look at the moving average line, it's kind of just going sideways. So that tells you that you might be in a pivot period where the market's deciding what to do. And then obviously that was the next leg down. Oversold, bounced back up, rallied temporarily, hit the 20-day move average, got rejected, came back up, closed above the 20, went back down. So you're going to have, and this is what I meant by volatility below the 200-day moving average, is you're going to have price movements like this where the market can't decide where it wants to go. You have bad news. Even in February, February is right around the time Russia invaded Ukraine, so that is definitely going to drive the market down regardless. That's sort of a black swan event. It's a smaller black swan event, but it is going to have a negative impact on the stock market. And then market rally back up, and then continue back down. Now, I believe the Federal Reserve, the biggest influence on the stock market overall is probably the Federal Reserve because the entire monetary system of the United States is debt, and the Federal Reserve is our central bank, and they're the ones controlling our money supply. So, if you understand that the dollar is created by the Federal Reserve, and the dollar is basically meaningless paper, it's just backed by how many dollars are in circulation, you can understand that market movement is heavily dependent on debt movement. So, if the Federal Reserve is going to start um, raising interest rates, that is going to have a negative impact on the stock market because money is going to get tighter. It's going to become more expensive to borrow, and thus there's not going to be as much liquidity in the market. money becomes more expensive and people tend to get more conservative. So they tend to pull their money out of more riskier assets like stocks, and they tend to transition over to things like bonds or treasury bonds or something like that. So whenever the Fed gets hawkish and starts to tighten their balance sheets, which means they're sucking money out of circulation. Um, this is what you're going to see, and that you could see the same thing play out in 2018 when the Fed temporarily raised interest rates. It had negative action on the stock market, but they pivoted fairly quickly, and then the market started going back up. So um, that's it's just a good thing to know if you're wondering how the market moves on a macro level. So that is pretty much what I wanted to cover. You could do other things like this. Let's see what the 3 year is. I'll just use the 3 year. Okay, so March 2020. Okay. So if you're investing in something above the 20-day, there's going to be mean reversions above the 20-day as well. So if we go back to over to QQQ, probably one of the last things you could do is to try to capture price action or mean reversions is look at the above the 20-day. So like I said, above 70, it's considered overbought and it's likely to revert back down below 70 again. So you could, if you wanted to, see if you want to capture those moves, and you could input something like, okay, if the 10-day RSI, let's just say of QQQ, oops, 10-day of QQQ is greater than, let's just do 70. That means it's overbought and it's likely to revert back to the mean. So you could go inverse if you wanted to and see if you could catch those quick drops. It's not always going to work in your favor, so just be aware of that. So you could try to plug in something like that to sort of use as a hedge or a mean reversion quick play to get in and out when you're trading above the 20 days. So let's see if that does anything to 52, 17. What was it before? 51? Yeah, 51 and 17. And now it's 52 and 17. It didn't change your max drawdown, which is nice. But again, that's just a way to, like I said, oops, what did I do here? It's just a way to capture quick declines. So right there, for instance, you would have captured a negative 1.14% move. Let's see here, you would have captured a negative 0.82% move, stuff like that. Um, you would have captured another 1% move there. But it doesn't happen nearly as often as um, these oversold areas. There, there, didn't happen there, there. So the oversold moves are a lot more frequent, and those you can take advantage of. And you can scale into those too. You don't have to just go 100% all in as soon as it dips below its RSI of 30. So, but yeah, that's kind of what that would look like, investing in or building a strategy over a long period of time. So let's go all the way back out and see what this would look like. Oops. I really need to get me a mouse. I do not like using these track pads, touch pads, whatever you call it. Okay. So yeah, that's what that strategy would look like over a long period of time. So when you compare it to buy and hold, it's gonna vastly outperform. You're taking more risk, but at the end of the day, your drawdowns are still not as bad as buy and hold. So max drawdown 24.9%, annual return 24%. Um, the beta is 0.34, so it just has it. It's roughly about 34% correlated to the S&P 500, obviously because we're buying buying the S&P 500 when it's above its 200 days. So at that point, we're trading right alongside of the S&P 500. So um, having a low beta strategy will help you. The biggest areas it's going to help you is in sudden drops in the market when you're still in a bullish position. So, oh, come on, dude. Um, okay, so yeah, if you had a zero beta or a negative beta strategy, these periods like this is where it's going to help you. So it's going to minimize your drawdowns in fast moving drops, and it's going to act as a hedge basically. So those are nice to have. And let me just plug in an example real quick. So let's do I think yeah, BTAL is a negative or an anti-beta ETF, and let's see what that would look like. So if we go back to around, let's go to 2018 because that's a perfect example. 2015 is a good example too. Okay, so 2018. Here we go. Okay, so the green is our strategy, the pink is the S&P 500. So if you look at the yellow, that's the BTAL, that's the anti-beta ETF. So that increased as the market was decreasing over that time. So not only did it go um, over the macro drop, it actually increased as the market was declining, and then obviously it's going to start to decline as the market starts to recover. So that's not something that's meant for buy and hold. It's meant as something to hedge your strategy against sudden moves in the market. So you have to know when to plug those in. We'll cover the zero beta and the anti beta stuff in another class. That will be a really good one to go through. So, but just wanted to give sort of a macroeconomic look at what the stock market looks like. And again, another good thing to do when you're looking at macro trends. So let's just plug in SPX. Um, Actually, I'll go to the monthly. So another thing you could do too is if you're looking at investing in the markets and you want to know when to get in, when to get out, maybe what to transition or what to pivot to, um, that's known as a parity switch. So what you could do is you could plug in commodities, you could plug in gold, you could plug in pretty much whatever you want. So let's say we plug in gold, and then this will tell you the macro movement of gold as opposed to what the S&P 500 is doing. So for example, now this is a monthly chart, keep in mind. So for example, right around COVID, as the market declined, oh, I'm sorry, that's oh 08, excuse me. Um, so as the market was in decline, gold started to trend upward. It did follow the market at first, but then if you look here, uh, gold quickly started to increase. Now, the thing with gold is at first it might drop with the market, but as you head into a recessionary period where you know economic conditions are going to be bad, that's when you will start to see gold increase in value. So, and you can kind of see that here in October 2008. Everybody knew we were probably heading into a pretty bad recession, whereas they didn't know maybe back in the summer of '07. Um, so as that was happening, as the stock market continued to drop, gold actually started to go up, and then that continued all the way into probably about the summer of 2011, and then gold started to kind of go sideways and then start to decline again. So you'll notice gold is declining here, while the S&P 500 is making its next bull run. So just things like that. You could let me go to the weekly. It might be a little better. So if you go here, this is just a comparison tool, so you could also plug in commodities. Let's see. I'll just plug in DBC. DBC is a ETF that tracks commodities, so that's another thing you could use as sort of a parity switch, because it's not correlated to the S&P 500. So you could look at investing in commodities maybe if stocks are declining. So good example again is summer summertime of 2007. Stock market starts sort of a downward trend, whereas gold and commodities are in an upward trend. But if you notice, June 2008, commodities and gold start to decline. Um, Gold sort of finds a bottom. I think as we figure out we're headed into a recession, that's when gold starts to take off again. Um, However, commodities continue to decline. Typically, when you're heading into a recessionary period, um, commodities, oil tends to collapse as you're heading into a recession. So they might be collapsing at the same time that stocks are collapsing. It just that's the way that the market moves. So if you're heading into a recessionary period, typically oil and stuff like that, commodities, they might start to collapse with the market. So just keep that in mind. But that's why you should use charts. You should look at moving averages, figure out which securities or which assets respect which moving averages because they don't all move in the same way. The price actions are not all the same. So if you take these away, let's just let's look at oil for an example. As an example, actually, you know what? Not even that. Let's look at long-term treasuries as an example. So I'll go with TLT. So let's go to the daily chart. And okay, so this is the 200 day. Yeah, that's the 20 and the 200. So this is long-term treasuries. And you can see they do tend to respect the 200 day. However, they move slowly or they move slower than, say, stocks. So what I like to do actually with the treasuries, let me zoom out even further. Okay, so where you could get beat up pretty badly is in these sort of sideways movements in treasuries where they they don't respect that 200-day moving average almost whatsoever. So what you could do is you could actually use a longer term trend to see if the 400 I've found works pretty well with TLT. You could play with it and figure out if something else works better. Um, but because long-term treasuries don't move the same way that the S&P 500 does, you can see that the long-term treasuries they tend to respect this 400-day moving average a little better than the 200. So touched it there, touched it there, touched it there, continue downward, rode right along it here, and then started its next upward move, came down. Let's see, sort of retested the 400-day, but then started its next leg down. Pretty much retested it there again, and then continued its leg down. So things like this, figuring out which assets respect which moving averages is how you can sort of build a longer term strategy. So you could do the same thing with, let's see, what was I looking at? Oh yeah, this was a good one. Okay, so yen, which is like a 3x leveraged bullish position in the Chinese markets. Um, this may not respect the same moving averages that say the S&P does or oil or whatever else. Let me just close that. I'll just use a regular. Like when I messed with this one, I found actually. Let me do this moving average cross. Can't remember what this one. I believe it was a 9-day and a 90-day. I can't remember exactly, but you can see yen sort of more so respects a 90-day moving average as sort of a longer term trend for this, but emerging markets are extremely tricky, and this one being a 3x leveraged one, you have to be very careful if you are designing a strategy around it. But it does tend to respect the 90-day moving average more than the 200. So yeah, just stuff like that. Just if you're not super familiar with TradingView, I suggest coming in here and playing around with the moving averages, changing up the numbers, using the MA cross. So this one is a 9-day versus a 90-day move average. What's nice is it'll put the little plus signs on the screen for you. This is where the two moving averages are crossing each other, and so that kind of helps you in building strategy. When the crosses are really close together like this, that's just showing you that it's chopping back and forth a lot, and you're probably going to experience your biggest drawdowns with these little groupings like that. So, um, but yeah, definitely something to play with. Like if you entered a position here when it crossed below, could have ridden a pretty significant wave down and then got out right here where it crossed back above. So it's just things like that. It's not always going to work, but it could work for prolonged periods of time. Here, same thing. 2017 could have rode that pretty much all the way up to 2018. So we would have got a year worth of gains off of that. Same thing here. Could have shorted it with Yang. Yang is the inverse of Yin. So, but yeah, that's pretty much all I've got for you guys. Looking at the chat, any Narwhal says any theories on ways to avoid getting chopped up in the chop. Okay, so he has to have 304. So, you know what? Yeah, there's a lot of things you could do to try to avoid market chop. One of the things you can do is let's go back to QQQ. And me myself, I'm still familiarizing myself with trading you guys. I don't use a lot of like drawing tools and stuff like that. So if I'm just trying to draw like free range lines or like freehand draw, I don't even know what that tool is. I never use it. But anyway, so what you could do, let me unplug that, plug that back in. Okay, so like that, for example, the sideways movement, that's all happening above the 20-day. So what you could do, because a lot of us I mean, let's be honest, most of us probably are in leveraged ETFs, so that's not going to help a lot, and it's especially not going to help in choppy markets. So what you could do is, let me see here. Let's go to the strategies that are on here. Okay. Um, all right, let's just go with the original TQQQ. Okay, so for us, like this year, this is sideways chop right here. Um, I think there's several different ways you could go about this. If you're trying to, I don't know if you're necessarily going to avoid chop unless you simply stay out of long or bullish positions above the 20 day or below the 20 day or something like that. As you guys can see, I've been kind of playing with this, trying out different things. Like I said earlier, I'm trying out plugging in TLT and BSV at the same time while shorting. I'm actually thinking about removing SOXS from the original and maybe just sticking with SQQQ or plugging in something else right here. Just because semiconductors, they're not, they will largely move with the Nasdaq, but not always. And a lot of times, I've noticed lately in the last couple of weeks, people have been getting destroyed by SOXS or SOXL. And I mean, it's a 3x leverage semiconductor ETF. So it's, as you guys saw Friday, or was it Friday? Yeah, yesterday. It's not uncommon for SOXL or SOXS to have negative or positive 14, 15% days. That's just the reality. So you're obviously taking a big risk when messing with that. So, but yeah, I think one thing you could do above the, this might be, that might be too complex of a strategy. Let's go to one of the older ones. Yeah, so um, we could take, this one's probably pretty simple. Okay, so this is, yeah, this one's pretty basic. Um, so current price of QQQ above the 20 day. So what you could do basically is, let's say you're above the 20 day, but you're trying to reduce some of your risk. Let me go up here and pick a back testing window. So like right here, we're seeing a lot of sideways movement, and at the same time, the SPY is kind of gradually moving upward, but then it goes back down. So I guess that's sort of sideways chop too. So um, let's start from October 14th. Okay, so that's a pretty good example of some sideways movement. The nice thing is you're not horribly losing to the normal market. You're pretty much going the same direction. Obviously, off rip, the market went up and you went down, so obviously you're going to be negatively correlated, or you're going to be below the market, but you're both going sideways essentially. So let's see, and that's pretty much happening when we go above the 20 days. So let's say we're in SPY, you could delete that. If you want to totally avoid it altogether, just simply go to bonds, and that's just going to make you go flat essentially. So So you see a drop, and then you kind of just sideways, and then the strategy kind of continues. So, let's see. Let's get rid of that. So if you go straight bonds, let's see what happens. So yeah, pretty much you're in bonds right there. So you could either do that, or if you want to put some risk in, what you could do is say put a portion of your portfolio, but not the whole thing. Maybe like let's do specified and say maybe only risk 40% of the portfolio, and then go we'll use QQQ. So you could do it this way too. You could put 40% in QQQ and then maybe the other 60% in bonds. So you could try that, but see they're kind of both declining. So um, let's do, let me back up. I want to see some other times where it was, September was a little bit back and forth too. You can try more complex strategies also. Like I know Garen's got his 1 day mean reversion of QQQ. Um, you could definitely plug that in those instances. Let's see. You could also do what is the let's see. What are we at right now? Yeah, basically you could take a smaller position um, on the short sides or the or the long sides too. The other thing you can do is try to look at actually go to trading view, and what you could do is look at rolling returns. So this is all right. So correct me if I'm wrong, but rolling returns is essentially the same thing as cumulative return. Am I understanding that right? Let's just go 10-day. Are you guys all seeing this?
Yeah, I don't think cumulative returns and rolling is the same. It's kind of similar though.
Okay, because you could, I mean, you could try to look at cumulative returns. Like, for example, if you're looking at the upward trend, right, and then it kind of reaches a peak, you can kind of look at the rolling returns too and say, well, I'll only go long so as um, maybe you know what, let's do a 20-day. Let's just keep it as a 20-day. And I'm actually going to go to TQQQ because I'm actually more familiar with TQQ than I am QQQ. Um, so you could look at these rolling returns and say, all right, well, if TQQ, let's say that was the peak, right? That's 48%. So essentially, in 20 days, TQQQ has gone up 48% basically, or the 20-day cumulative return is 48%. I think that's what that means, but maybe I think I'm wrong. Um, but you could essentially put a cap on your gains and then get out. So it's kind of hard to mimic what that would look like. Let's see. greater than the 20-day. Okay, so what you could do is delete that and say if let's just say if the 20-day cumulative return of I'll go back to QQQ. So you could say if the 20-day cumulative return it's right around. Let's see how often that's happening too, though. It's probably above 12, maybe. Yeah, it's going to be hard to gauge. Let's see. Can use a shorter window of time. Some of these peaks. Screw it. Let's just say five and a half. So you could say if the 10-day cumulative return of QQQ is greater than, let's just say 5%. Let's just keep it conservative. um, then go to bonds, essentially. And then if it's below that threshold, just stay invested in QQQ. I think you could do something like that, basically, um, to try. I mean, you could try to avoid the choppy periods, but it's gonna be difficult. You have to really understand what you're doing. So, but I think there's several different tools. So, okay, so let's see. So just by adding that 10-day cumulative return of QQQ greater than 5, brought it from 235 uh, to 255. Is that right? Let me make sure that's reflects what I did. Yeah. So that actually brought the return higher. I think it kept the same drawdown, right? Yeah. So it brought it from 235 to 255. And let's see if it. Yeah. So like here, kind of got its gains and then got out and then waited for a shorting opportunity. You're still going to see some sideways movement. It just is what it is. But actually here it helped. So you can notice we went up, dropped a little bit, and then kind of went up again. This section right here is not as choppy as before. So you could try something like that, but you need to know what the mean reversion is going to be on cumulative returns, and this is a good way to measure that. So you could look at a 10-day period, look at a 5-day period. Let's try 5. No, that's too frequent. Okay. But essentially, this is sort of telling you what the mean reversion is. So that's 5.99. I wonder if I can even up it. Let's do 5.5. Yeah, so that brought it to 278. So it is helping. The cumulative returns rule is helping a little bit. So I think it's helping to sort of act as a take profits. You know what I mean? But so, something like that. Like I said, you could use Garen's 1-day mean reversion plugin. That's basically a plug and play. So that kind of helps you get in and out quickly. But it's much more, how do I say, it's much more unique. It's much more advanced, but it does work. But like I said, something like this can help you too with the choppiness. Um, or you could just go straight QQQ if you want. Um, but yeah, I I think that's about all I've got for you guys. Let me look. I want to look over here too. Um, let's look at 2008 because a lot of this was some sideways movement. So yeah, this might have helped you too, using that cumulative return rule. Um, it might help you avoid some of the choppiness. So I would suggest looking at something like that, because then you might be able to stay away from getting back in, getting back out, getting back in, getting back out, because this is all sideways movement right here. And this is what is this, the end of, okay, yeah, this is the December 2008, January 2009. So yeah, something like that. Does anybody have anything else? Any questions? Let me go back to the recently replaced TQQQ on version 4.2 with SPXU because the SPX is performing better than NDQ. Thoughts on adjusting symphonies to changing market conditions? Yeah, I mean, you guys, hey man, once the strategy's out there, it's out there. You can change whatever you want on it. Everything is based on your preferences. So, I mean, yeah, that's a great point though. If you notice that the S&P 500 is trending better than the Nasdaq, like right now, the Nasdaq might be choppy because obviously tech companies are reporting earnings, and some of them are missing, some of them are excelling, and so you might get that chop on the Nasdaq. Yeah, absolutely. I mean, pivot if you want to pivot. I encourage it if that's what you're looking to do. Does anybody have anything else? Any questions? Or anything to add, I should say.
No, I
No, I
think
think
this
this
was
was
great,
great,
Derek. I
Derek. I
really
really
appreciate it
appreciate it
and
and
your
your
time
time
today.
today. Thanks a lot. Thanks a lot. Really appreciate it. Hold on. Let me close. Let me get this out of the way real quick. Who was that just popped on? Sorry.
That was
That was
Jason.
Jason. Oh,
Sorry.
Jason. Okay. Okay. Yeah. Cool. Thanks, man. I appreciate it.
Yeah,
Yeah.
thank you.
Yeah. This is. I really look forward to doing a lot more of these. This is one of the biggest things I like about being in this Discord is interacting with the members, maybe educating some of the people that are not aware of either TradingView or some of the macro trends, stuff like that. So yeah, this is going to be a lot of fun. I really look forward to doing a lot more of these.
Awesome.
Awesome. Cool. So yeah, if anybody doesn't have anything else, I'm gonna end the stream. Hopefully, I can upload the recording. We can have it. I'll work with Garen on that. See if he can help me out, and maybe we can chop it up, edit it, or something, so it's not so long. I know it's kind of a long class. So, but yeah, you guys have a good rest of the day, and we'll talk to you guys in the chats.
All right.
All right.
Thanks,
Thanks,
Derek.
Derek. Yeah, you got it, man. Have a good day, guys.